The second will be what are the common traits and characteristics you've seen in your personal experience with certain companies, certain sectors. And then lastly, we'll talk about how this applies to the blockchain and crypto space. What's the same, what's different. I'll also let these guys, I'm not going to do them justice if they introduce their deeper backgrounds themselves, so I'll let them do that.
Okay, so you want us to introduce ourselves?
Yeah, if you could just quickly introduce the depth of your background, and then we'll get into it.
Okay, my name is Mike Arrington, and I'm from America, and I'm an investor. Before that, I was an entrepreneur, and before that, I was a lawyer, and that's it. I'm the founder of TechCrunch, if anyone's ever seen that, and then I had a venture fund, and now I'm in crypto. And my fund is, well, it says up there what my fund is, so that's me.
My name is Genping. From Vertex Venture.
We cannot hear you. We cannot hear you.
Yes, we have mics right here.
So Vertex is a collective fund managing different regional funds covering China, US, Israel, Southeast Asia. Holding is under Temasek individual funds with external LP money. So we typically focus early stage investment from mostly Series A onwards. So I belong to a Southeast Asia team.
Okay, my name. My name is HH. I'm the head of venture investing for SGInnovate. We're a fund wholly owned by the Singapore government, whose main objective really is to help scientists, entrepreneurs build great companies from Singapore for the global markets. And we do this in a number of ways. Obviously, investing is just one dimension of it, but we also help them venture build, complementing them in terms of what are the areas that they lack in terms of technical and business expertise. And we have a talent networking team that helps them to staff up. And finally, we've got a brand and community team that helps them to spread their gospel across multiple geographies and markets. Thanks.
Hi, I'm Nix from the Philippines. I'm wearing two hats really. One is Eden Holdings. It's the largest technology holding firm in the Philippines. 7 out of the 10 most valuable tech companies coming from the Philippines were either co-founded by us or we were the first seed investor in. The other hat that I wear is I also represent a blockchain project called the Open Data Exchange. Thanks.
Thank you. So let's just dive right into the first topic. I think scaling means a number of things to a number of folks, but if Mike, we'll start with you. What do you view as a successfully scaled business, and what are you looking for specifically?
Okay, so I'm not sure why I'm on this panel. So there's a saying that well, I don't know if it's a saying, I'm gonna say it. Like those who can build companies, those who can't become investors, right? And so I'm an investor. I'm not very good at building companies. I'm a terrible manager. I had every startup I ever did failed until one got lucky. So I have no idea. I mean, some of the companies we've invested in have done that, but I had nothing to do with it. I can take credit for it and probably talk about it, and I will if you want me to, but I'm just saying a bunch of shit, right? So that's what I think. I will say this, and maybe it'll start a conversation. I don't mean to make you guys uneasy. I can tell right away you're like, uh-oh. But sometimes the guys that start the company, or women, have so much passion and charisma and drive in the face of the impossible that once things actually get into growth mode and stability mode, they just fuck it all up. I can say that in Singapore, right? That they mess everything up, and sometimes that's a good time to make a change. But every time one of my companies did that, the companies fell apart afterwards because you needed that very charismatic founder. And so we found that the best thing you could do is actually hire a number 2 who was the grown-up. The boring grown-up person who can build the business. And you still have the crazy founder. You still have the Elon Musk at the top or whoever. And that has been a recipe for success as an investor.
I'm going to sum that up by saying you need to know what you don't know,
I don't know anything.
and once you realize what you don't know, you
Yeah.
still keep doing it.
Yeah. But seriously, why am I on this panel? Like, I think that,
We'll get to that. We'll get to that.
Yeah, I guess it's a tough one. So from investor perspective, yeah, from especially from Vertex, obviously we are backing the founders who can lead the company through its different life cycles. So I totally agree with you. Bad things happen along the way, but since the beginning, it's a decision that whether you like the founder and you think the founder will stay around. If very often, if we don't think the founder stay around, then probably that become a very fundamental challenge we need to consider whether to get into the investment or not. So I guess maybe the number one foundation for success is whether the founder himself is scalable or not.
scalable. Yeah.
Yeah. Basically, has a capability to learn, willingness to learn, and capability to expand his personal capacity along the way through different stages. I guess that's the number one. Yeah.
Okay, I think as we invest in very early stage startups, scalability is actually very important to us. Obviously, I'll speak a little bit more on what entrepreneurs, the aspect of entrepreneurs, and what we look for in them in terms of their ability to scale the company. But it's also very important for us at the decision-making stage, whether or not fundamentally the technical or the business model itself can scale. And I'm aware that people pivot and they sort of change, but if fundamentally the product or the service does not scale, then that is probably something we will want to discuss. They could probably still build great companies, but they would not be what we would term venture investing companies, because they don't get that hockey stick kind of growth where you don't have to keep on piling more people to fulfill contracts, where you can just take one product and sell it 1,000,000 times, which is what we would, as venture investors, we would sort of prefer. To the topic of the entrepreneurs, I think most entrepreneurs we meet really want, it is about what is their ambition as well. Some of them say, hey, we want to build, we are quite happy to build a $100 million company. And then you're going to start to see them take issue with you and you try to push them out. And we've had some difficult conversations with some of our companies that have actually grown from C all the way to A and B and C. And then we say, hey, I don't think you guys are going to take you all the way to the pre-IPO, or the market just isn't going to like your face unless you buy a tie or something like that. And these are the kind of entrepreneurs that we have got to establish very early on, whether they are receptive to that kind of structure, or whether they know, more importantly, whether they know what their strengths and their weaknesses are.
Hi. I think passion is the lowest common denominator thing any founder must have. If he or she is not passionate about the problem that they're solving, then it doesn't make sense to move on to the next sort of series of questions. But personally, for me, what's most important is that the founder or founders have a strong grasp of the unit economics of their business. I've found a lot of founders in Southeast Asia, to get to your first $2 to $3 million is actually not that hard, especially most likely if the channel was via a B2B sort of relationship. I've encountered so many founders that has a relationship with a large corporation. Their family's connected. That large corporation gives them that first $2 to $3 million. But to scale beyond that, where you really have a business model, the customer's never heard of you, there's an indication from a B2C perspective that there's strong product market fit. Those are the things that I look for. The best pitches really are the ones where the founder can say something like, oh, it cost me $1 to acquire a user, the customer saves $2 and I made $3. Something as simple, of course it's never as perfect as that type of scenario, but if someone is able to illustrate that, it's out in the wild, they're able to measure it, you look at the total addressable market and it's very large, then this becomes math. just then that becomes, oh, I know if I pour in $1 million worth of jet fuel, that becomes $3 million very quickly, and customers love it because they save $2 million.
Mike, let me ask you a quick question. In your previous business, you're pretty well known for TechCrunch. At what point did you realize that business had scaled? At what point did you take a look at it and say, oh shit, this is made?
I want to answer a different question. No, I just want to just have a conversation, and then I can answer that if anybody actually gives it, any cares. But the way you talk about business is awesome, and like it seems like a way a business school student would learn about business, like sell your products for more money than it costs to make them is excellent. I come out of Silicon Valley, and I find that so much, like I know that you can make money doing business that way if you find the right market. It's just so boring, right? I remember when I launched TechCrunch, one of the first companies I covered was YouTube. And if YouTube did the analysis that you said, like there'd be no YouTube, like they're like, well, we're gonna lose, the more successful we are, the more hundreds of thousands of dollars we're gonna lose every month in streaming costs and their storage costs. YouTube was losing like tens of millions of dollars a month, and then they got bought for $1.6 million, and one of their founders races like F1 cars now. And so I just find that to be like so much more fun, and maybe that's why I love Silicon Valley, is that with software, you don't have to worry as much about unit economics because you have zero marginal cost on your goods. And I get very passionate about that, and it's why in crypto I get passionate as well, because there's the network effects, and you don't have to worry about unit costs because you're not dealing with real world goods. And so I think the only reason why I'm passionate about business is because of technology that allows us to sometimes skip the stuff you're talking about and focus on pure passion of the user and the beautiful user experience. And if you can nail that, then anything is possible. And so anyway, just thought I'd throw it out there for different types of businesses.
I guess in terms of context, the Silicon Valley obviously has copious amounts of access to capital, the founders there. When you take it to the Philippines or maybe Indonesia and Singapore have much more, today, obviously not compared to the Valley, but today much more robust pools of capital now. But if you take it, you're talking about Vietnam, Philippines, or maybe to some extent Thailand, with much less venture capital, if you don't at an early stage illustrate that you have the ability to generate potential cash flow, whether you recycle the cash flow and revert it back to more customer acquisition, I think is a strategic choice. But if you're not able to illustrate to potential investors who tend to be family offices, large corporations, that you can have a business model that's scalable, you're going to hit this point where your growth hack techniques at the start suddenly don't generate the kind of returns that you're looking for. And then you're going to have to spend on customer acquisition. And spending on customer acquisition is a business model competition. Because the way both Facebook and Google work is you're constantly bidding up the cost of the audience, and he who is able to have the best margin to bid up that price versus the others has a very strong competitive advantage versus their competitors.
I don't disagree.
But I think that nowadays the VC mentality between Asia and Silicon Valley is not really that different. The part you raised about unit economics as of now versus in the future is something everyone is trying to adjust to, right? Even like for YouTube, I think investors make the investment thinking that it drives a user passion, but on the other side, 5 years down the road, it will be converted into advertisement revenue. It's just like in Asia, probably it takes a lot of investors a while to really build up that kind of mentality. It's a number down the road rather than now. Some of the investors are still looking at right now. Every time probably some startup they meet what's the unit economics now. But a good investor share like what's the potential unit economics will happen in 5 to 10 years.
So I disagree. I'm a really good investor. Terrible at many things. But I'm a really good investor. Because I invested in Uber, I invested in Pinterest, I invested in Airbnb. And that was just the first 3 companies I invested in after I left TechCrunch. And none of those companies made any sense at the time I invested in them. I believe in the founder, and this is one thing that I think Silicon Valley does well and taught me well. There's many things it does wrong, but I invest in the founder because so often their first business idea sucks and they get going and they just blow it. But if it's the right person, and I actually think like the right psychological profile, the right level of drive and intelligence, they will make something work, or they have a good chance of making something work. One of the hottest companies in Silicon Valley right now is Slack. You guys all know Slack. I know it's not as big in Asia. That's a pivot. It was a different business. It was the founder of Flickr actually founded a business. The business took a bunch of money. It was a total shit show. But they built Slack internally, and they're like, oh, this is it. So I invest in people, and I couldn't care less about the business plan. And it drives some other investors crazy because they're like, well, what are the economics? Like, I don't know, but that guy right there, I want to invest in. And sometimes it fails, but it seems like more often than not, just investing in people is a really good way to go.
Great, but that's a stage you are doing angel investment and in the early stage.
Yeah.
When scale up, that's a different topic.
It's a totally different topic. I just find it so boring because once it's at the stage where you look at the financial statement, it's like it's just a binary yes or no. It's just like, ugh. Like I don't know. I just think it's less fun.
That's why someone even do the boring stuff, right?
Yeah, I don't want to do that.
Michael, I hear what you say because I do both angel investing as well as institutional. Angel is for the fun, we invest in things that we are passionate about. We invest in passionate founders. Actually, there's another dimension. Everyone talks about passionate founders. I look for passion and resilience because that resilience is important because things fall apart very quickly, and if they don't have that resilience, they don't know how to pivot, or they are too wedded to an idea that isn't going to proceed. But as an institutional investor, my board doesn't really care whether it's interesting or not. They want to know, how the deal is structured, and so I guess we sort of balance the two. And I've got to do a good selling job if I find that I'm very passionate about the founders and I like the idea, but it is a little bit too difficult in terms of unit economics to make sense.
Thanks, guys. We have about 10 minutes left, and for the audience's sake, I'd like to shift over to this discussion and apply it to specifically crypto and blockchain. So when you look at founders in this space, and when you look at teams in this space and various business models, whether or not you're looking at unit economics, whether or not you're looking at tech scaling, whether or not you're looking at community building and marketing, what do you look for, and for the people in this room that are trying to figure out either how to invest or how to operate or how to navigate, what are some keys, and I'll replace scalability with success, because I think this is a type of industry where it may not be winner takes all, but it is a little more leaning towards that network effect than, for example, a traditional unit economics that can accommodate a lot of different players.
Mm-hmm.
Anyone?
So crypto is I've been a tech entrepreneur and angel investor for about 20 years now. Crypto is an interesting sort of space that I admit versus a number of people in the room I'm betting, still newer to the space. In traditional technology, there's this thing called Metcalfe's law, which is the law of network effects. Effectively, the growth of a network or the adoption of a network exponentially increases and not increases from a linear fashion if the experience of every member of the network gets stronger each time you add a new participant. So one cell phone equals value of X, two cell phones equals X to the power of N.
Look for the network effect. Right? The network effect.
Yes, the network effect, so Metcalfe's law. What's interesting, and I don't think anyone sort of created a formula for it or tried to fully grasp it, is what is decentralized Metcalfe's law? Where the value of the network doesn't, most of that doesn't accrue to a central authority. So take that same example with the cell phone, right? As you add one more cell phone user to the network each time, Metcalfe's law says, oh, then I have more people to call and text and communicate to, and so the network keeps on getting stronger, and so you have this very steep curve. But really, telecom operators probably get a large chunk of the value from the profits that they get by rolling this out and the scale effects of this. But in a theoretical decentralized Metcalfe's or network law, each time you add a new user to the network, perhaps every call gets cheaper, perhaps every text message gets cheaper, and perhaps the data access gets cheaper. What kind of adoption curve will you have then? So I mean, there are things that blockchain can potentially turbocharge into a lot of the things that I've learned as a tech founder for several years. And it's interesting to see which entrepreneurs are able to leverage off these capabilities as they roll out their projects.
Yeah, so as early stage investor, I guess some of the principle or philosophy we stick to is basically the market size, unique positioning or differentiation, and the funding team, which apparently is the most important. So for crypto space, we think generally it's the same philosophy or same principle. The difference is probably the mechanism of building up tractions or the way you monetize. But those are just like mechanism. It's not the principle, it's not the philosophy. So the challenge, of course, is to tell the real traction from the metrics. So there's a lot of trading volume, but for a real business, you always come to the fundamental part of the business. What was the solution you are trying to build to solve people's pain points, right? Take it, Bitcoin, for example. Either you're arguing for store of value, how many people are using for store of value? Or you are arguing for payment, how many people are using it for payment? Rather than just volume. Of course, the volume, the volume itself also have a lot of value to provide liquidity, but that's another aspect that we are trying to at least differentiate. So always come back to the foundation, like what's the pain points you're trying to address when you start, when the project was started at the beginning, and trying to measure are you really, is the project really on track to address that kind of pain points rather than just looking at the general metrics. I just feel like by only looking at like general metric without really understanding what those means doesn't really help that much.
I think as an investor, as an institutional investor, I am most wary of those blockchain companies that try to tackle very big problems in very entrenched and established institutions. For instance, in the financial sectors. I've seen a myriad of companies proposing solutions that's going to overturn the trading systems, that was going to remove the need for clearing houses, for clearing banks. And when you look at the stakeholder diagrams, you say, these guys are not just going up against a procurement team, they're going up against big organizations like Bonnie, State Street Global, that actually have got entrenched businesses in these areas. And which bank would be that? Which bank would actually want to pull up all the infrastructure and replace it with what you have, just for the kind of benefits that you bring to the table? So for me, we look at companies that try to tackle smaller scale problems using a blockchain. In the full spirit of disclosure, tech that we invested in looks at the management digital identity for refugees. It's an area no one really wants to spend a lot of money on. The governments look for the cheapest possible solutions. Donors want to know that their money actually reaches the refugee that benefits from it. And that's the kind of company we want to put money into, because we believe that we have to start small before you're going to build a global network.
All right, so I disagree with everything on that. And it's a good way to make money, and it's not a bad way to do it, and most people do it that way. But what I do is different, and I do a lot of investments that no one else will touch. And here's what I do. And it's only because I hate the stuff that you guys just talked about. I just hate thinking about it that way. I look at it like last night, Jim bought me dinner. Radecki, the guy that interviewed CZ up here, and we were having this debate over whether Michael Jordan is better than Magic Johnson. And most people in this room are old enough to know what the hell I'm talking about. But and he's into Jordan just because he's from Chicago and like it's the trendy thing to do. I like Magic Johnson because he's actually the greatest, probably athlete to ever live. But you look at just that athlete, right? And I look at it from a Freudian perspective. Like I've actually done some real like high-level courses in Freudian psychology, and you actually look at their personality types. And most of the people that hit us up for money are either high-functioning psychopaths or high-functioning narcissists. And you can make money on both of those. But what you really want are the schizoids, right? These are the people that are schizophrenics when they're low functioning. They talk to themselves, etc. But on the high end, they're artists and they're creators and they're Steve Jobs and people like that. Those are the people you're going to make money from. And you just take that person, forget the business plan, forget everything else, just take them and put them in front of you and move everything else away and just look at that person. They probably are on the spectrum, right? They're probably super antisocial. They're probably a little bit off. And they're gonna make you so much fucking money, you can't believe it, if you get the right supporting team around them. In my world, in Silicon Valley. CZ is a wonderful human being, has great personality and social skills. He's very high functioning, he's schizoid. A lot of the people in this room who are very, very successful entrepreneurs are schizoids. And so that's what I do, is I look for those people and then I try to put a good narcissist around them on biz dev. I try to, sorry, Jay, you're in biz dev, I didn't mean to say that, but I try to put like a good OCD person around them to really actually make sure things get done. I have two OCD partners actually. And I'm actually a paranoid personality type, which means I'm terrible at most things. But that's it. I just look at that. I don't care about the business plan. I really don't. I pretend to, because you have to talk about something, but most of it I'm just talking about it to figure out what their actual personality type is like. And then I try to figure out if they're actually ethical, good people on top of that. Because you don't want the low-functioning psychopaths who are going to steal your money and all that. That's it. And it's truly it. That's all I do is I look at the human being and what they're like, and then who's the supporting cast around it, and just let them be the artists that they want to be. That's it. And I think at early stage it works very well.
I love this guy. Yeah. I really do. I mean, that is exactly, I mean, honestly speaking, you know, that kind of flexibility, that would generally be the kind of thesis that, you know, some of us would like to employ. But as I said, you know, it takes all sorts, you know, the reason why there's not one big huge VC in the world or one big huge angel investor in the world is because all of us are different, each of us have our own thesis and objectives, and that means you guys can raise funds from someone, one of us.
That's great. We have 1 minute left, and what I want to do is shift now from scalable businesses to the industry itself. We're in what I believe is still a relatively early stage in the industry. Everyone up here has gone through and worked personally through the original .com period, as well as the financial crisis 10 years ago. Just your thoughts in the last minute on how this industry scales going forward. What point in that curve are we? The industry, the overall blockchain crypto industry. In other words,
we have very little infrastructure right now. I think that's what you're asking. Yeah, so hopefully we're at the very beginning. If not, you know, none of us are going to be here next year, right? Or very few of us. So yeah, if this is the end, this is bad.
Okay. Let me put another question. Let me put another bit about from a timing standpoint. Where do we get to scale in this industry? Is it the next year, 3 years, 5 years, 10 years?
Yep. Yes.
All of the above.
I think it's hard to put an exact time period, but really it's when the regular Joe gets cheaper prices, gets to, for every dollar of time or capital that he puts in, he gets a bigger return versus a more centralized non-blockchain approach. That's when things scale by itself, and that's when the organic effects really kick in. When people's lives get better, they don't really think, oh, did it have this much TPS? What kind of architecture does it have in the background? Ultimately, people care about very basic things. Am I getting it cheaper? Am I getting it faster? Do I have a better quality of life because I'm using this solution? And blockchain, just as any technology, should be invisible to the one it gives the most value to.
I think for us, there is a certain vision that we have of where blockchain is going, and it's a vision and a path that's not going to be unique or one that blockchain is going to thread on its own. We sort of see a convergence of technologies, IoT as sensors, blockchain as being the sort of the communications protocol and security layer, and AI behind it making a decision. And we're starting to see a few companies or some big companies actually exploring the merger of these three technologies into developing new products for very small scale communities to test out how all these things can work out.
Yeah, I guess just not that much to add. I think generally we agree that we all agree. That's why we are here. It's direction. It's a big movement. So we are still at early stage of this whole industry.
Thank you guys. Please round of applause for our panel. We're out of time.
Thanks, dude.